Now, first things first, what does their proposal say? Well, firstly, they want to tax trusts at 30%, which is the median or close to the middle range of personal income tax. So the idea is to equalise across various sorts of entities. So how's this proposed to work? Well, what the proposal says is the trust will be taxed on its taxable income. Um, Actually, not the distributions, which is kind of interesting. The announcements in the press and the government announcements were it'd be taxed on distributions, but that's actually not what the proposal says. So there's a subtle difference, which could be important in certain circumstances. So, firstly, as I said, 30% of the taxable income of the trust. The trustee is liable. Okay, now for some trusts, that's an individual. So you could be, as an individual, liable for the trust's tax. For a lot of trusts, they have a corporate trustee in place. They can be $2 shelf companies. Most of them are, with any luck. You do that for various, protection purposes. So the trustee becomes liable for the trust's tax. And there's some discussion in there about who, from a mechanical perspective, how do you do this? So we're going to have trust tax returns and a trustee tax return. That's one potential. So basically, let's double the administration for trusts. There's some discussion there about how to actually make that corporate trustee pay the tax. Okay, so the problem is this. If you've got a $2 shelf company and it owes $1 million in tax, well, it can just go bankrupt because it's got no cash to pay the tax. So the ATO is proposing a look-through mechanism so that the directors of that company become personally liable, which is not unprecedented in tax law. But at the moment, it's a pretty extreme situation to make the directors of a company personally liable for the tax debts of that entity. So again, that's another smack in the face, if you will, for people who have a trust.